Hi, everyone, and welcome to another episode of the M&A Mastermind Podcast, your go-to source for the latest in industry trends and strategies to help you take your M&A practice to the next level. I am your host, Nick Olsen, Managing Director of Cornerstone International Alliance, the only international alliance of M&A firms who focus on the lower middle market. We are here in this format, this podcast. We bring in masterminds who are experienced, knowledgeable, and gracious enough to share how they have succeeded in the M&A space. Today's guest, I'm really excited about. He is a very experienced valuator, and we're here to talk about valuations and assessments and what those mean and how we go about attacking those. He is an accredited senior appraiser, which he received from the American Society of Appraisers. He is a partner with Exit Strategies Group, an investment bank in Northern California, where he leads their business valuation services. He has valued companies across all industries and sizes. He has a particularly deep interest in wineries, craft beverages, and technology companies. He has authored many publications around valuing businesses. Please welcome my guest today, Joe Orlando. Joe, thank you for joining. I appreciate you taking the time out today.
Yeah, Nick, it's a pleasure.
All right, so let's dive in. So here at Cornerstone, we do a lot. We do a lot of different meetings, and quarterly we get together our valuations group, and we talk a lot about different things. And one of the topics that we want to talk about today, that we want to share with our audience, is the difference between a valuation and an assessment. Something that we've talked about in the past. But I want to just kind of take a quick step back, and what I just read off, you mean very rich background in business valuations. So how'd you get into this profession, and what got you where you are today?
Well, like everybody, I got into it in a different way than I intended. When I graduated from college, I started with a small investment banking firm out of New York called C.J. Lawrence, and we had 4 people in the investment banking group, but the majority of the revenue was generated from trading revenue and institutional independent research. So the banking group was not connected to the research group, which certainly was the past in terms of selling research and selling coverage in the investment banking practice. So we had a very small group, and that group ended up, C.J. Lawrence ended up getting bought by Morgan Grenfell, which is a merchant bank out of the UK at the time. And Morgan Grenfell became C.J. Lawrence Morgan Grenfell. And I went and worked with the Ivy League guys up in Midtown Manhattan in the analyst program. So banking was really what I was focused on, high level, middle to high market investment banking. I spent a good amount of time doing that for 2 years, and then ended up not wanting to live in New York and moved up to Boston and got an opportunity to do some fundamental valuation, which is what I call it. Fundamental meaning hypothetical, willing buyer, willing seller, doing it for a scope of work that's a little bit different from an M&A perspective. And so that's how I got into it. I went back and forth. I worked for a portfolio management firm for a few years. I went to grad school for a few years. I ended up working at a small, well, not a small, but a good-sized investment banking firm out of Arlington, Virginia, called Freeman Billings Ramsey. Sorry, I blanked for a second. And FBR was a co-manager on an IPO with Credit Suisse First Boston's technology group out of Palo Alto. I hit it off with that team, and I was offered a job, and I ended up being a technology investment banker out of Palo Alto and one of the biggest, at the time, the biggest investment banking firm in the world, which was interesting, and worked down the hall from Frank Quattrone. And that, unfortunately led to, when the towers fell and the investment banking business kind of imploded and Frank Quattrone's name was on the front page of the Wall Street Journal, it was kind of tough to find a job for a little while. And I ended up going into fundamental valuation back into fundamental valuation with Bearing Point, which had just changed from KPMG Consulting. So
Hmm.
that led me down a path of valuation that, is that really was the start. And, with a few stops at Silicon Valley Bank and another another great name to be into the on the front page of the Wall Street Journal. And 12 years at an accounting firm, leading a fundamental practice and doing reviews of financial reporting valuations. I reconnected with Al, and Al was looking for someone to run the valuation practice so he could focus more on the M&A side, and it's been a really good partnership since then.
Yeah. And that leads me to my next question. So at Exit Strategies Group, you guys are, I'd say, uniquely structured. We have 27 M&A firms in our alliance right now, and I think you are probably the only one structured like this, maybe one or two others. But you have an M&A side, investment banking side, and a valuation side.
Yeah.
Now, obviously, those two go hand in hand, but you also you yourself lead the valuations side of the business. So what does that what does that all entail outside of quote unquote M&A valuation or assessment?
Well, it's a lot more frequency. So we touch probably 80 to 100 firms a year in terms of valuation. When I say firms, I'm not talking. Sometimes 25 to 30% of them are not operating businesses; they're holding companies, they're family limited partnerships. We do a lot of valuation that we call discount letters, effectively valuing a portfolio of assets and applying a discount based on the operating agreement or buy sell agreement. So that's where it's different. That has a very low correlation to the M&A practice. However, if you look at the exit strategy of a owner of a low to middle market company, it starts with identifying a baseline value, goes through an idea of how it's going to look, what the planning is, what the timing is, and then at the end assessing value so that you can effectively put an ask price or have that ask price established when you sell a business. So we're on both ends, and we have great partners in the middle that we both hand companies off to and introduce companies to, or they will introduce us to a business that wants to sell. So our network is definitely one of exit planners. It's one of attorneys, accountants, and our own development, our own marketing. But at the beginning of that process is a hypothetical baseline, or a baseline that's based on a hypothetical willing buyer. And usually that hypothetical willing buyer is, for lack of a better term, a private equity firm or someone who wants to buy the business and generate enough cash flow to pay down the debt and grow the business, and then sell it at a higher price for over a 5-year holding period. We don't look at it that way in particular, but our model's based on that type of framework in a 5-year forecast. If we're looking at a multi-period discounted cash flow and so forth, the assessment is a most probable selling price. What will it sell for? And that will include private equity firms at a low end of that range, but it is by definition a range. What will a strategic buyer pay for it? What will what will someone who has to have the asset pay for it? So it's crazy money. And I remember when I was in M&A back in New York, my second year out of college, a buyer asked, what is it going to take to buy the, or what is this company worth? What are we going to need to pay for it to get it? And I said, well, that's for you to tell me. And multiples are easy for bankers, right? Because it's an exit multiple, right? You figure out what the price is, you take a metric, you divide by it, and it's easy to calculate. But when you're looking at those transactions, it's hard to tell which ones are buying them for fundamental reasons, which one for strategic reasons, and so we build that analysis into our discounts for lack of control and marketability. But my point is that the market tells us what it's worth at this point. I have to identify what I think it's worth. This is always correct. This is almost never correct because I have nothing to compare it to. I don't have any transactions. Sometimes I do. Sometimes the stock sells. But if it's not a third party transaction, arm's length, it's kind of hard to say it's comparable. So there are a lot of differences. We use the same model. So I'm in charge of the model and making sure it's updated. And need to do that for this year with the year-end returns and so forth. But yeah, I mean, the assessment really is what gets us to that endpoint and creates that, you know, the end of that relationship. Whereas
Mm-hmm.
my work is in many ways the start of that relationship.
Right, right. Yeah, so evaluation there serves a different purpose than an assessment. I know you guys do both. If you, I mean, when would you, from an M&A perspective, do you guys mostly do a business assessment?
Oh, before we do M&A engagements, absolutely. But we do it a little differently, and we do the assessment separately. So the assessment's not built into the decision to take it to market. The assessment's just that. It's an assessment. What do we think it will sell for? If the
Mm-hmm.
company is not comfortable, at that price, or they want a higher price and they feel like they need to execute in order to get there, then we'll give them ideas as to what they should do to execute and bring. I mean, the values, it accelerates exponentially if you can get the company to generate higher EBITDA by refining their processes or investing in certain things. We're not the corporate development team, but we are someone who can suggest what those things may be based on what we see in terms of value in the market. But by doing that, you also, a higher margin company usually sells for a higher multiple. And so, and a larger company usually sells for a larger multiple. And a diversified company usually sells for a higher multiple. And really, that's a matter of risk. You can mitigate risk of having one product by getting a portfolio of products. You can mitigate, risk of financial by generating higher EBITDA and banking, as much as you can to pay for working capital, to pay for that expansion, but also avoiding debt at high interest rates right now. So part of our assessment at the end, Al does a really good job, and so do the rest of our team of identifying what he thinks they can do in order to grow the value of that business. And if they're not comfortable selling it now, they need to execute on that. And that's more of a quarterly contact. See how they're doing and whether they're ready to sell. And unfortunately, right now it's the opposite. At the time that we did the assessment, they wanted to sell, but because of the current environment, some of those numbers are going down, and so it's harder to sell. A company that's got declining revenue or declining earnings. But fundamentally, I think that most of the buyers that are buying something will not walk away from that transaction, but certainly use it as an opportunity to get it at a lower price.
Right. So you guys have your valuation side of the business. Who does the valuation work? Who handles the business assessments? And you and your team are not necessarily doing the M&A transaction, which is Al and his team. So there has to be that seamless handoff and transition. How does that kind of take us through how that transition works so you can arm the advisor, M&A advisor, with all the necessary information that he or she needs to know to present it to their client?
Well, I mean, we're fortunate to have a really strong group that's worked together for a while, so that handoff's
Mm-hmm.
really not that difficult. The key connection between the two is really the model, and so whenever there's a model, I'm sort of the 411 911 phone call in terms of where can I get this information. I'm looking at this. This doesn't look right. Talk me through how you built it or how it was built so that I can understand what I'm working on. So we have a smaller group. So we hired our first analyst last year, and Matt, who's from Michigan, is really good at balancing those two because he really wants to learn about M&A. So he's helping out with the sale process, the SIMs, the assessments, but he's also working with me on the valuation. So that connection is actually a good one. And we're trying to hire an intern over the summer. We picked one, so hopefully, I don't get a lot of resumes because we don't have any more open. But I do a lot of teaching in many ways, and that came from working at an accounting firm for 12 years and being the senior person and having the majority of the associates be straight out of college after a 1-year program for the accounting firm, which did a great job with first years. And once they declare, some declared to go directly into valuation because they rotate it through valuation. So a lot of presentations to the first years, a lot of teaching, a lot of sitting people down and explaining things, walking through the model, teaching them what an option pricing model is, and so forth. So I consider myself at times to be a teacher, as well as an executor. I execute a lot more than I did back in my accounting days because it's a smaller group. So I need to pick up the execution side a little bit more often now. But yeah, it's I think a seamless process is almost impossible, but it does have a strong connection between the two groups through the model and through Matt and through my help with the valuation model.
Yeah, absolutely.
And the best
Do you,
practices that we get from Cornerstone are immense. I
mm,
mean, the fact is that knowledge doesn't just come from me. It doesn't come from Al, or our exchange of knowledge through our advisors, but it certainly comes through Al's active participation at the higher level of the CIA and our monthly calls. And I think that ROI in terms of our investment in CIA has been phenomenal in terms of that shared knowledge and best practices.
yeah, no, I appreciate you throwing that in there because that's what we're all about is connection and sharing information and working together and helping build each other up.
Mm-hmm.
So, what a question I kind of off track here, but in an M&A situation, do you offer at what point do you offer a formal valuation? Maybe you don't. Maybe there's certain situations that you do. And if you do, how do you handle the question? Well, why do I want a valuation? Which is more, it's more formal. It's more expensive than a business assessment. Why would I want that as opposed to a business assessment?
So at the beginning, when we've identified first of all, we have specific scope of work sometimes where an M&A situation doesn't come into play. So that low correlation work is mostly all formal valuation work.
Hmm.
Or we have a partner divorce, or we have a divorce, or something that won't logically lead to a sale. But when we engage with someone who says, "Hey, I want to sell this company maybe in 3 to 5 years, but I need a baseline valuation." The first question I ask is, "Well, are you going to try to utilize a gift tax exemption and give some of the ownership to your employees, your children, your family? Is that in your plans? And if it is, then you are going to need a formal valuation. So as long as I'm calculating a baseline, let me do a formal valuation that will allow you over the next year because that report has a 12-month shelf life. Over the
Hmm.
next year, to decide whether you want to if you do want to gift and when you gift and at what percentage. And so what I try to do in terms of any valuation is try to identify situations where they can get a higher return on that investment, and it's not just a compliance exercise. Because I learned very quickly with 409A valuations that it's a compliance exercise and it's a commodity, and so you're chasing zero, especially when your competitors are trying to sell cap table management software and giving away the valuation for free. And so my goal in my move from an accounting firm to an M&A firm or a valuation M&A firm was to avoid that commoditization of what I do. And some of the biggest suppliers of business valuations for 409A are made a huge investment a few years back in AI. So sometimes you're not even talking to anybody. I think that the goal for me to identify and differentiate myself is to talk through what the need is and see what I can do to increase the value associated with that need, or ask some follow up questions that may lead to an introduction to Al and his team. So I have a note on
Hmm.
my calendar today that I need to introduce Al to one of my valuation firms because they are looking to possibly sell.
Hmm. Hmm.
I'm sorry, not valuation firms, valuation clients.
Yeah, yeah. Do you offer, I mean, I guess, it's probably a little different what you got with you guys and how you're structured. Now, how often do opportunities come in towards the M&A side that, and I think you guys always want to do a business evaluation or appraisal, right? So, one is that, you always want one of those and why. And two, if it's coming from the M&A side, how does that get handed off to you guys to kind of run with, an assessment? And then, because I would imagine, and let me know your experience, if it's coming into, Al and his team, I want to sell my business, but we recommend you have a business assessment, most times, right? How does that work?
Well, I mean, when leads come in, or if we get contacted by one of our networking sources, we identify pretty quickly whether it's an M&A opportunity or a valuation opportunity. So
Mm-hmm.
Al's never going to talk to the accounting firm that wants a family limited partnership valuation. It's always going to go to me.
Mm-hmm.
And if they are actively trying to find an advisor to sell their business, it's always going to go to Al. But obviously, there are things in the middle that we need to figure out, and so really, it's either Al or myself, depending on where we think it may go. Picking up the phone, calling them, asking them questions, trying to figure out what they want to do, and then suggesting after that call that it should go to Al or it should go to me. We do suggest that assessments be done before that conversation really goes much further, just because we we don't know what the business is worth, and they can say, usually there's a rule of thumb when you talk to business owners, and they'll say, well, I've heard it's 4 to 6 times EBITDA, or I've heard it's 45 or 45% of revenue. And those are not necessarily dangerous, but those are starting points of value. And you have to explain that, saying, hey, look, we need to look in and do our diligence, because we know the buyers are going to do the same diligence. They're not going to look at value with the rule of thumb. They're going to look at it in terms of cash flows, in terms of what the future looks like, what they can identify as risk, and what they're going to pay for it. So that really involves a deep dive that you really can't do with a quick rule of thumb valuation. So we try to explain that to them, and if they're price sensitive, we may, or they're smaller, we may do it for free. We rarely do, but I think we have situations where we're dealing with a friend, or we're dealing with a close contact that we're fine with doing it, but we won't do a full report or anything like that. We'll just get a number and talk through that
Mm-hmm.
number.
Yeah.
That's pretty easy. That's sort of the 80/20 is, getting the number, but the assessment is really digging in and finding out I call them nuggets of value, but what the
Mm-hmm.
intangible values are,
Mm-hmm.
whether their brand is, strong or weak, or whether they have a strong position within the industry. You can't get that from just the quantitative analysis.
So,
So we try to remind them of that, and
yeah.
at some point in time, they just don't want to spend the money, and that's fine. I mean,
Well, that
it's
kind of leads me to my next question. If someone's, I don't want to spend the money on evaluation, and is it worth it? Why would I want to do this? What's your sales pitch to a business owner? When they have those reservations about doing an assessment or evaluation.
Yeah, I mean, it's we try to simplify M&A by using a very simple analogy, and that is selling your house. You can say that we paid X number, X thousand for our house. We want to sell it for 50% more, or so forth. Well, you need to do some research. Fortunately, there's Zillow. There's no Zillow for businesses. So, but there's Zillow to get an idea of what the value of your house is. Well, Zillow is based on market comps. It's
Mm-hmm.
based on appraisal. It's based on assessments. It's a very strong tool, but it's a tool a tool that incorporates data that's easily can easily be pulled from public records, MLS, that sort of thing. And so you wouldn't go sell your house without trying to identify what you think it's worth, because you may think it's worth $1 million because you want $1 million, but it's only worth 800,000. And so, you know, you're not going to get anybody buying at $1 million, because that's the price that you need to make a good profit. And so
Mm-hmm.
I think that's where we try to use analogies like that. We try to identify opportunities, like I said, with regard to gifting, and estate planning, exit planning. But more importantly, the establishment of a baseline value that's based on a deep dive and a formal due diligence, I think is important for a business owner to understand, because business owners, even 5-10 years before they sell their business, they say, well, what is my business worth? I have no idea. I know that I make money, but I have no idea what that business may be worth on an open market or a hypothetical market. So they're just inquisitive. And I think those are the serial entrepreneurs, or entrepreneurs who buy and sell businesses maybe 2 or 3 times over the course of their careers, or start and sell businesses like technology firms, and understand when the time is right to buy and when the time is right to sell.
My apologies in advance. I'm going to put you on the spot here with a quick example. Do you have anything
Okay.
that pops to mind? When you're looking at an opportunity to come in on the M&A side, and you were like a good success story that you can share, that maybe a valuation really informed a business owner, whether he or she should go to market or not, and if it said, yeah, now's a good time, based on that valuation, how that maybe help them kind of have the lights turn on and be like, oh, this is a good time, or maybe I need to do this, that, or whatever, to increase the value. But based off of the work that you do, how that positively impacted a client that is likely selling their biggest going to be their biggest financial asset of their life, and they're looking to maybe move on to retirement. Like, anything that you come to mind that you want to share, like a really cool story?
Yeah, I mean, we had so I've only worked on one M&A engagement with Al, and I did that for educational purposes, and really helped Al with the sim, with the with the buyers list, with the data room, that sort of thing. But it was a unique client in that they were a California machine tool company, and um, there were a lot of ad backs, a lot of them, and so the business was really used as um, a sort of a bank account for the owners, not just the majority owner, but other owners. And so, um, when you look at the business without the ad backs, it's not really worth much because it's minimizing taxes. But if we had a we had a very deep dive of what those ad backs were, and we established, Al and I, early on, that the biggest challenge we have is selling those ad backs to a potential buyer,
Mm-hmm.
because they need to have as much detail as possible. And so I think the purchase price was surprisingly higher than I think the owner expected, because we were able to establish an EBITDA that was significantly higher than what they were recording. And so we were able to identify opportunities where they didn't have to sell the land and the assets, and they could lease those back. And
Mm-hmm.
yeah, in the end, they got a really good price on an operating business, before all this inflationary pressure, and interest rate increases came into play. The company, probably, if we sold it right now, would probably go for less, but I'm sure that they're still as strong. Um, from an earnings perspective, they probably are even stronger because the buyer was a public company that brought a lot of synergies into the business. So, um, and the opportunity to have to participate in some of that equity, with a 20% stake, gave them a better opportunity to take a bite at the apple when that value is at a point where the buyer feels like they can maximize by selling either the entire business or that particular business.
Mm-hmm.
So yeah, I think
Yeah.
there are opportunities where we have the ability to walk them through what our process is to identify how we're going to try to maximize value, and they've never thought about that before, or they've thought about it but they've never identified how to calculate it.
Mm-hmm. Mm-hmm. Yeah, that's a good way to look at it. You're trying to maximize value and sell the company at hopefully the highest price, but that's not always the most important thing. The structure of the deal, and find the right buyer and legacy and all that sort of stuff all comes into play too. But I think that's it's a really cool story where essentially they went into this at probably an expectation of a price, and you guys through your business assessment work were able to identify ways in which the sale price inevitably was higher than what they were looking at, right? Is that kind of?
Yeah, I mean, don't get me wrong, they want it more because they and when I say they want it more, they weren't greedy. It's just that they wanted to identify when we identify what we consider to be the synergies with each potential buyer. They wanted some of that value, and our point was, look, they're rarely going to share that value with you because they are bringing it to the table. They're paying you for the value you've created, not the value they've created. But it will give them the opportunity to have a cushion of increase that will likely get them the deal if they feel that they need to increase price. But that's our job to make sure that they understand who the other what their competition is for the business and what they need to do to get it done. So I think if you were to talk to the majority of our clients on the M&A side, first they love Al. And Al does the majority of our M&A work. So they love working with Al, but they love working with our other advisors, Louis Cianci, Roy Martinez. I mean, these guys are, people that are well-liked by our clients, and they maintain contact with them because at some point, our sellers, because at some point in time, they want to refer them or, they have another business they want to sell or so forth. But in terms of, the value that we add, I think that they would all say that they feel that they either got the right price, a fair price, or a price that exceeded what they expected. And we rarely get to a point where we're selling a business for what we below what we think it's worth, because we're just chasing a fee. I mean, in many ways, that's the most difficult decision of a load at any investment banker, right? Is don't calculate the fee before the transaction's done. I mean, I know that's tough, but you feel like you're walking away from $1 million fee. Well, that $1 million fee, the seller's walking away from a significantly lower price, and that's much higher than $1 million if that's the case.
Right. Well, and I think, to me, the moral of the story is for these business owners, it makes a lot of sense, and us as M&A advisors to really, advise our clients, or at this point, maybe potential clients, on you really should get a valuation or an estimate of value or a business assessment or whatever, just to establish, a benchmark or a baseline even as to, these are where the expectations are, and then we can go out and see what the market bears. But I think to be correct, I think you would agree with this, Joe, that, truly to understand, what this process might look like for you, to have that benchmark of a business assessment is key.
It is, and sometimes if there is price sensitivity, and we don't want to give away our product, we'll do something a little bit less. We have something called a quick calculation of value, which is really just that. It just it looks at market multiples, it looks at financials in a in a summary manner, and says, look, we could argue for something like this, but this is probably going to be the high end or the low end, or somewhere in between based on the multiples that we're using. But that's a pretty straightforward process that will allow us to do calculate value for a few $1,000s. And we don't usually provide a report with that. It's just a verbal communication that gets done over a 1 to 2 hour meeting, and it really can be a good starting point for a company that is not really sure whether they want to sell, is not really sure whether they think it's worth anything. It's a baseline, but it's not as strong of a baseline as an assessment or a full valuation.
But I'll say then it can kind of tip the scale for the business owner too, like, oh, maybe now's a good time to sell, or maybe no, it's not based off of this. We got some work to do.
Exactly, and I think also what helps us, which is also fair and logical, is that we're going to tell them if they want to do a formal assessment, we've already done some of the work, so we're not going to have you pay for it twice. We'll give you a credit for the $2,000 that you paid. If our assessment's $10,000, you only have to pay the incremental $8,000. I'm sorry about that. I thought I turned
Sorry.
everything off. But the fact is that we do that for all of our assessments as well,
Mm-hmm.
with a success fee. If the success fee, so they're going to get that $2,000 back for the assessment, but they're going to get the entire, $10,000 back on a success fee, because I think that's the fair way to do it.
At the close of the sale, you mean?
Yeah.
Yeah.
Upon success, a successful sale, we'll credit that as part of our
Credit that
fee.
back. Yeah. Very cool. Well, Joe, I really appreciate your time and really explaining the differences between evaluation and an assessment. I know we dove a
Yeah,
little bit deeper into the assessment on the M&A side, but I think it's important to consider that for your business, for your clients, and Joe's been a huge resource for me and for Cornerstone International Alliance members as well, with all of his extensive work in the valuation space. That he's been a tremendous resource for us during during my time here with CIA. So I appreciate you, Joe. Where can people, if they want to learn more? I know you do a lot of education and blogs and articles and publications and things like that. Where can people find you and more information about your work and the work of Exit Strategies Group?
Yeah, I mean, if you just go to the Exit Strategies group website or search Exit Strategies group, you'll see that there are drop downs for the team, and you just go to my name on the team, and you'll get my CV, my bio, my contact information, my email address. In terms of education, I'm going to be working with an investment banker in the wine space, as well as a appraiser of vineyards, to look at valuations of wineries through BV Resources, their training pass program. And so that's going to be a fun opportunity in March. And then, I try to do one or two things a year in terms of those types of presentations. I try to do them with people that I know and I like and I respect in terms of their knowledge, and so that makes it a little bit more fun for me.
And we were talking about wine. What better industry?
Yeah, exactly. So maybe you and I can write an article together on the value differences between the San Francisco 49ers and the publicly owned Green Bay Packers, and what makes either one a better team in terms of winning on Saturday.
We'll definitely have to see how that goes.
Right.
I'm not. It could be. It could be great for the
Yeah.
Packers.
Who knew that Jordan Love was going to be the Trey Lance of the planned Trey Lance of the Packers.
The original plan of Trey Lance that kind of
Yeah.
went sideways. Yeah.
Yeah.
Well, again, Joe, thank you so much. That is all we have for this episode of the M&A Mastermind Podcast. One thing that would really help Joe and myself out is to share, comment, like this episode, and send it off to anybody who think could who's in the valuation business or who's thinking about it or wants to learn more about business valuations and assessments. This would be a great episode to send them. But you can see all of our episodes at cornerstone.com/podcast. And thank you for joining today. Until next time, appreciate it.